Did you know that over 90% of individual investors fail to beat the market over the long term? It's true. Despite all the advice out there, most people struggle with making profitable investment decisions. But here's the good news: you don't have to be in that 90%. Value investing has been proven to beat the market over time, and it's a strategy used by some of the world's most successful investors, like Warren Buffett. In this video, we're going to show you how to make investing easier. No more stress, no more guessing. You'll learn how to find undervalued stocks, avoid the common traps, and even generate passive income. Plus, we'll reveal why patience, not speed, is the key to long-term success. Stick with us, and by the end of this video, you'll have the tools to make smarter investment decisions that could change your financial future forever. Chapter 1. Unlocking Hidden Gems. The secret to finding undervalued stocks. The first step in value investing is uncovering stocks that are undervalued. The key is looking for companies whose stock price is lower than its true value. A popular method here is the price-to-earnings (P/E) ratio. Stocks with a lower P/E ratio might seem like a deal, but you need to dig deeper. Look for companies that have strong fundamentals, like solid earnings, manageable debt, and consistent cash flow. According to Warren Buffett, price is what you pay, value is what you get. A lower price doesn't always mean better value, so don't be fooled. In 2008, during the financial crisis, many stocks were trading below their real worth. Those who saw the hidden gems, like Apple, at the time, reaped massive rewards. So, how do you find these hidden gems? Start by looking at companies in strong sectors with competitive advantages but temporarily undervalued because of market sentiment. Chapter 2. Patience pays off. Why waiting is your best investment strategy. One of the most powerful strategies in value investing is patience. If you're a long-term thinker, your chances of success increase dramatically. Famous investor Peter Lynch once said, "The real key to making money in stocks is not to get scared out of them." It's easy to get caught up in the daily market swings, but value investing thrives when you hold on and wait for the market to catch up with your analysis. Consider Coca-Cola in the 1980s. When Buffett invested, the stock was undervalued due to a sluggish economy. But Buffett knew that Coca-Cola's brand would continue to dominate, and decades later, that patience has paid off. Don't rush to sell your stocks when the market gets rocky. The best investors know that the magic happens in time. Chapter 3. The discount store of the market. How to buy stocks on sale. Imagine walking into a store and finding a high-quality product at a discount. That's what value investing is all about. When stocks are on sale, it's your chance to buy them for a bargain. The trick is knowing when a stock is truly undervalued, and when it's simply cheap for a reason. A solid indicator to watch is the price-to-book (P/B) ratio, which compares a company's market value to its book value. A P/B ratio lower than 1 suggests the stock may be undervalued. But remember, the key to making this strategy work is doing your research. Look at the company's earnings growth, debt level, and industry position. If a company's fundamentals are strong and its stock is on sale, you might just be looking at a great buying opportunity. Don't forget to subscribe. If you're enjoying these tips, hit the subscribe button to keep learning how to make investing easier and smarter. Chapter 4. Avoiding the trap. How to recognize overhyped stocks. Now, let's talk about the opposite: overhyped stocks. These stocks are often pushed by media and social trends, but they're rarely the best long-term investment. A stock might be the talk of the town today, but if it's overvalued, you could be setting yourself up for disappointment. The price-to-sales (P/S) ratio can help you avoid these traps. This metric compares a company's stock price to its revenue. A P/S ratio higher than the industry average can signal overvaluation. It's essential to keep your emotions in check here. Just because everyone's talking about a stock doesn't mean it's a good buy. As investor Charlie Munger says, it's not supposed to be easy. Anyone who finds it easy is stupid. Chapter 5. Maximizing returns with dividends. The power of passive income. Another great strategy for value investors is to focus on dividend stocks. Dividends are like a bonus payment for holding onto your stocks, and they're an excellent source of passive income. The beauty of dividend investing is that you don't need to rely solely on stock price appreciation. Look for companies with a high dividend yield and a consistent history of paying dividends. Companies like Johnson & Johnson and Procter & Gamble have raised their dividends for decades. This steady stream of income can make investing feel much easier. Think of it as a way to grow your money while you sleep. As Benjamin Graham, the father of value investing, said, the investor's chief problem, and even his worst enemy, is likely to be himself. Chapter 6. The Zen of Value Investing. Staying calm in chaos investing can be stressful, especially when the market goes haywire. But the best value investors stay calm and stick to their strategy. One of the best ways to make life easier as an investor is to cultivate emotional discipline. The stock market will go up and down, but if you can keep your emotions in check, you'll make better decisions. A good way to develop this mindset is by focusing on the long-term value of your investments rather than short-term market noise. Legendary investor John Templeton once said, "The 4 most dangerous words in investing are, 'This time it's different.' Stick to your plan and avoid chasing trends." If you've done your research and bought quality companies at a good price, there's no reason to panic when the market dips. Thanks for watching. Be sure to hit that subscribe button for more investing tips and strategies to make your financial journey smoother. Value investing doesn't have to be complicated, and with the right mindset and techniques, you can make it work for you.